Hello, investors. Thank you so much for joining me. So, my name is Michael from Deep Value Returns on Seeking Alpha. Today, it's episode 15 of How to Invest. I'm going to go through a few things. So, I've called it like a three plus one topics. So, I'm going to go for three topics that I think are quite interesting to talk about right now. And then I'm going to go through and I'm going to have a free book recommendations at the end. So, it's kind of a three plus one. Um, this kind of feels like it's a bit of a better format. I was kind of doing it before live, and when it was live, I was kind of wasn't as prepared, and I didn't feel like I was really giving people enough value. So I kind of reverted back to just kind of doing this, recording this myself, and then I kind of posted up there. In this way, I believe that I kind of can give you more high value content rather than just taking questions on the go. This was actually some advice that someone gave to me after listening to a few of my podcasts, and I agree. This I think works best. So I'm gonna go through this, and I hope that for the next like 25 minutes or so, you'll just enjoy this and get at least if you get one thing away from this podcast, I think that I've done my job. So thank you so much. Let's get started. So here's the thing, right? It's the past 8 weeks have been really, really difficult for. I mean, it's been really tough, and I get that, right? A lot of people kind of feel like, oh, are you still bullish X, Y, Z? Are you still kind of how do you feel about certain things? Nothing has changed in my perspective. Those businesses are still great businesses, and you might own some great businesses as well. Don't doubt yourself. The share price moving is not an indication or is not a reason for you to react. Okay. I say to everyone, the most difficult thing oftentimes in investing is sitting on your hands and doing nothing. And it's difficult because you kind of feel like you have to do something, and you stay there on your phone, you're kind of watching the tickers go up and down, and it's absolutely pointless. And someone reached out to me and said, "Oh, like this time last year, someone reached out to me and said, oh, in last year's November, someone said, oh, I wish that I was investing in the COVID period because if I'd been investing in the COVID period, I would have just bought everything at the bottom. I would have bought it and I would have just held on to my dear life." And I wonder what that person's doing right away now because right now we're back to where we were, so what is that investor doing right now? Are they buying everything in the sun or like they're panicking? And that's the thing, right? If you have capital on the side and you see stocks continue to fall down, you're like, oh yeah, good job I didn't throw good cash after bad cash. I feel like I'll just wait for a better time. I'll wait until the stars are aligned. I'll wait until the outlook is a bit more stable. I'll and you're kind of waiting and waiting for the dip, but the dip is here, the dip is now. I mean, that's right, this is the time. And to be absolutely clear, there's not someone ringing a bell saying, hey, hello, this is the bottom right now, and everything's going to get better after this point. It's not that, when the bottom comes in, and there's some kind of news on the Wall Street Journal that says, guys, everyone, it's the bottom right now. In fact, the news at the bottom is really, really bad, right? It's really, really bad. It's just that the amount of capitulation, the amount of investors throwing in the towel has just slowed down slightly. So the amount of people selling is just kind of just from the day before has just slowed down a tiny little bit. It's not that all of a sudden things are just surprisingly much better. It's just that the pace of selling has slowed down. And I know it's difficult to comprehend this. And this is true. This is actually really healthy for the market to be able to have these moments, and nobody wants those moments. Nobody wants it when everyone hears the stocks go down as well as up. In their minds, everyone's like, okay, yeah, stock goes up, I know that, yeah. But it's actually really healthy for the businesses or for the market to be able to let off some steam every so often. And I know that nobody wants periods like this, but these are really, really important. This shows a healthy market. The market is a function that allows businesses to raise capital. And if you're having a bit, too much exuberance, and you end up like with sell-offs that are akin to, let's say, 2008, you don't want that. Nobody wants that. So it's actually quite healthy to have these sell-offs because it shows that it puts kind of people's gambling instincts at the side a little bit. So it's actually a really good thing for the market to be able to let off some steam. Now, nobody really wants that. Everyone wants kind of share prices to just go up and up and up. But remember, the share price is a reflection of the value of the business. Businesses don't grow to the sky, irrespective of what you might think. You know, businesses are more or less correspondent over time to the growth of free cash flow or projected free cash flow over time. So it's a very clever estimation of many people having some view of what the total free cash flow will be in the future relative to what they're willing to put down right now, or discounted at an appropriate level. So it's businesses don't go to the sky, and if you have periods where share prices totally dissociate from underlying businesses, that's not healthy because the market isn't functioning properly. The other thing that I wanted to highlight is remember that in December it's tax loss season, and everyone's just like selling, dumping their shares because everyone's trying to kind of manage their tax profile. Now, that's not a reason for you as an investor to sell out of your businesses. You've bought a business, and your business has a certain amount of value, and it's not relative to how it's the 12 months is up and now you have to kind of sell out of your business. It's not like that. You are the owner of that business. You've deployed capital to get a return over time. It's not that it's December and you got to take care of your tax losses and now you kind of sell out of your businesses like parachute out. I mean, this is just nonsensical. And to be absolutely clear, this doesn't mean you have to kind of go in and buy every single dip, right? Because in practical terms, there's a limit to how much capital do you have, right? You have your salary coming in, you may have some kind of dividends on the side or something, but there's a limit to how much capital you can kind of use to buy dip. The most difficult thing in investing is really just sitting on your hands. And I remember when Buffett, always a good story to talk about Buffett. Buffett talks about the Washington Post when they were buying the Washington Post in 1974 or 1973, around there. And everything was collapsing. There was like the Watergate scandal, and it's like everyone was in panic. And Buffett says, obviously I wasn't at the time around, but Buffett says that any normal analyst could have told you that the business was worth somewhere between, let's say, 4 times as much to a 6 times as much. Anyone could have, with a reasonable estimation, say that the underlying business that the Washington Post held, the holding company, that there was like cable channels, there was like newspapers, or stuff there that was worth a lot more, but there was just mass panic, and they bought in, and after they bought in, the share prices continued to fall and sell off. And these are like the best of the best, and these are like folklore stories, and they, like they didn't time the bottom either. It wasn't that they were like so smart and they got it at the bottom ticker. It doesn't happen like that. And whenever you make an investment, it's not that you made the investment and then it's like tomorrow morning it's like, oh, John Peters made the investment and now the share price is going to go up. Like it doesn't work like that, right? You make the investment and nobody knows and nobody cares that you made the investment, and you just have to be able to sit on your hands and just ride it out. So, and I know it's tough, right? And I know that kind of it feels painful to deploy capital today and to see it in like 2 weeks' time, like 30% down. And you feel, if I just been like waited a little bit longer. But if you look from today over the next 2 years, it doesn't matter that in 2 weeks it's down 30%. Because if as long as you come out in 2 years' time, let's say with 40 or 50% gain, who cares that in the interim period it kind of sold off a little bit? I mean, it happens, and you shouldn't kind of feel too kind of despondent or too emotional about that. Another thing that I want to say is that um, at times people have written me in with some questions that they kind of want me to address, and I've tried to address them here today. And feel free to reach out, and I've seen people kind of build up some more confidence and stuff and kind of reach out to me with some questions throughout the week. So if you have a question, don't forget to kind of, do write to me a comment anywhere you find me. Just, yeah, drop me a comment. I kind of read through those comments and I try and kind of pack it in, and I try and deliver the answers to those questions when they can come up. Because someone particularly asked me about investing in tech right now, like what my thoughts on that. I've tried to kind of, as much as I could, try to really give you some kind of overarching view on that, or some perspective that it doesn't matter too much like what the market is telling you right now. If you are an owner of a business, you just sit on your hands and you just have to wait it out. And that's fine. And that's absolutely okay. And it's kind of good for you to kind of get a different hobby aside from just looking at the share prices. Like I like to go out and exercise. You can kind of do something else. And I spoke to someone in deep market and deep value returns the other day. I was saying to the person, it was last Friday or the Friday before, and the market was tanking as it has been for the last several days. And they're like, oh, should I kind of go in and buy some more now just before the market closes? And I said, my best advice to you right now is to go and do 2 sets of 20 squats, because after you've done that, you're struggling to breathe, and your ability to actually breathe is so much at the forefront of your mind that you're not going to worry too much about what the market is doing. And sometimes you need that. You need to kind of dislodge a little bit, and you need to kind of just to shake out a little bit from just looking at that. And what I find surprising, if I look back to the bottom of 2020, it's like it looks now so far in the hindsight, like it looks so far back. And at the time, I remember, like I was writing in March 23rd, and I wrote a blog to people saying, in big capital letters. I don't write it like that in big capital letters. I wrote, "We're over the worst right now," and I didn't know that on the 23rd of March it was actually the worst that the market was going to be at. But what I wrote then is that it doesn't matter if it falls another 5, 10%, or even 20%. You have fallen the most it's going to fall. The majority of what it's going to sell off, you've already done that, okay? So even if it falls off another like 5, 10, or even 20%, you're already way over the worst. So now, like the risk reward is actually much more favorable, and that's the thing with investing, right? Because it's kind of really contrarian thinking, but ultimately, the more scary and fearful it is, actually the odds are significantly more in your favor. And it's like really perplexing, because like the more fearful it is, and like you look at something that has meaningfully sold off, as long as the business is kind of relatively reasonable quality, if the share price is like down significantly, the odds are much more in your favor of you seeing a favorable reward over the next, let's say, 2 years or so. But people don't, they don't take that to heart. And I'll talk about some of the books that kind of help me out think about this later on in the episode. But I hope you found that kind of helps you think a little bit through this. Now, someone wrote to me and said, Michael, could you explain again about that the stop clock? So the stop clock, what it means is that anytime that you sold out an investment, you stop the clock in your investment process. So if you say that you are trying to buy a business and you're waiting for your return over the next 2 or 3 years, anytime that you exit a position, you're moving to a new stock. It's a stop clock. So you kind of stop in the clock on the process. You kind of have to go back to square one and kind of start again. And if you have this in your mind that you're going to stop the clock by moving to a new stock, you kind of think to yourself, okay, like, is it really worthwhile? Because the stock that you're moving to always looks so much more appealing. I like, it's a new stock with a new idea or a new story, and it's founder led, and it's always so jazzy, and it's like, oh my god, this is like the thing I'm gonna do. But the business that you're in right now, and it looks like it's dead money, that's what everyone else is thinking as well, that it's dead money. And that's why it's cheap right now, because nobody else wants to own it right now. And that's why the returns are actually more favorable by you actually just staying put. And because the returns don't come in a smooth line, okay? It's bumpy. And it's kind of like 2 steps forward, 1 step back, 2 steps forward, 1 step back. And it's kind of like that, okay? And that's absolutely fine. And another thing that I'd like to highlight is that a buy and hold investor. What is a buy and hold investor? Because I don't really know what a buy and hold investor is, right? So everyone is like a buy and hold as long as the share price is going up. And I always say, you don't know anything about a business until you've gone through a significant drawdown. Because when you made an investment, the share price goes up, you're not asking any difficult questions about your investment. You're not kind of really digging in and thinking about yourself, do I really understand this business properly? Because if it goes up, it's not difficult. You feel like a genius. You pat yourself on the back. You tell all your friends about it. They're like, oh yeah, like this, that, that. And it's just chitter chatter. It doesn't make any difference. When you go through a drawdown, at that point is when you start to think about the business fundamentally. And everyone is like a different strategy when it kind of goes through a sell-off. It's like, oh, some people have a 10% stop loss, some people have 15% stop loss. And I say, don't have a stop loss, person or man or whatever, woman, whatever. Don't have a stop loss because the stop loss was designed for one purpose, to make brokers rich. Brokers make their money from selling you stock, okay? That's how they make their money. Doesn't make you wealthy from having a stop loss, okay? Sell out of the business on your terms if it makes sense to you. Don't sell out of a business because it's been a bit volatile and you know you've been stopped out. That's just nonsensical. And everyone's like, oh, I'll give you an example of Netflix. So if you look at Netflix, arguably one of the best investments, of all time. Okay, and there have been days over the last 10 years when Netflix has sold off by 40%. I think I counted two. I think there may have been three times that the stock was down 40% in a day. One of them was when they decided to stop doing DVDs, if my memory is correct. Um, but there's been at least two times, possibly three. You can check this afterwards. And can you imagine that? If you've been invested and you see your stock go down 40%, you're like, I'm out of here. Now, of course, I've picked the hindsight. I've done that. I get that. But you need these stories, you need these case studies to kind of think through investing. And it's not like the tyranny of the antidote. You need to kind of understand. If you don't build this framework or these quote unquote mental models, you're not going to be learning anything. You need to kind of go through, see what's worked, see what hasn't worked, and why, and try and understand that. So a lot of people that even were investing in Netflix like in 2010 or whatever, by 2011 they sold out of the stock, and a few of them would have held on until 2012. And so, what is a buy and hold invest? I mean, it's very easy to look in hindsight. And as I said, I wrote about it in one of my articles this week. I said that if you like, it was a quote from Adam Smith's Super Money, or I think it's called Super Money, where he talks about if you don't know what type of investor you are, this is an expensive place to find out. Or you don't know what sort of person you are, this is an expensive place to find out. So I don't pretend to be a buy and hold forever investor. So I know what I'm looking for. I'm looking for a business that people don't want to buy right now. I'm looking for a business that I favor. I'm looking for a business where the valuation appears to be really, really attractive. I know that I'm not going to always be right, but I'm looking for the valuation that makes sense. I'm going to buy it now. And obviously, because I'm buying something that people don't want to buy, it's very volatile because people don't want to buy our business. That's why I'm buying it, because I believe that people misunderstand the actual fundamental quality of the business. And I hold on to a business for about, let's say, a year and a half or two, and I'll get that return. And it's not going to be a smooth return. It's going to be like good weeks, bad weeks. And it's kind of like, but it's really holding on with the grip of death. And you're just holding on. And 2 years later, you hope that the market has come around to your way of thinking and you exit the position then. So it's not the case that I'm saying I'll hold on to the business for 10 years, because nobody can predict the future. And it's very difficult to say, oh, this business is going to be the best business for the decade ahead. Like, no one can predict the level of disruption that you see. Businesses are coming out all the time that they're just picking away. Look, even Microsoft. Microsoft is one of the few businesses that has been in the leading top businesses in the world for in the 1990s and in the 2010 decades. So, but in that interim period of 10 years from 2000 to 2012 or so like that, it went practically nowhere. So a person would have had to have held on for 12 years. That's a really long period of time. It's like a third of Nelson Mandela's jail time. So you'd have to kind of had such a high level of conviction to hold that. And that's, it's easy to say, but it's really, really difficult to do. And a lot of people say that they've done that, but I do question if they've actually done that. It's easy to say some of these things, but it's difficult to really implement in practice. And it's if you understand what sort of investor you are, there's nothing wrong with improving your strategy, but you need to have a very clear understanding of what sort of investor you are, because if you don't know and you go through this period where the market sells off, you're going to be slightly lost. Okay, and you need to have the kind of vision in your mind of how you're going to position yourself so you're not going to become overwhelmed in investing. Okay, uh, so this is the first topic that I wanted to talk about. When it comes to investing, you need a strategy and you need to define why you're picking the business that you're picking before you pick it. Don't pick it because like your friend's talking about it, because your friend can be gone and out of it and you wouldn't even know. Okay. Pick the business that makes sense to you. Write down a couple of points why you want to buy this business. One of them includes the valuation. So you do the work, you make a small position, you wait 6, 8 weeks, you buy a little bit more, you wait another 8 weeks or so, you buy a bit more, you go through the earnings, the next quarterly results, you try and see. This is what I wrote in my 3 bullet points about the business. I was looking for XYZ. Let's say I was looking for customers increasing by, let's say, 10% or whatever year over year. I was looking for revenue growths kind of to be ticking along at, let's say, at 5%. If it's a slow growth business, I was looking for it to be growing at 20%. If it's a reasonably fast growing business, if I was looking at to grow at 40%, if it's hyper growth business, you have some kind of idea in your mind and see if the business continues to do it like that, and don't be lulled by, however, if the stock market is kind of reacting positive to those results, that doesn't necessarily always mean that it makes sense to stay invested. Okay, so think through, but really start small in adding to your positions. Okay, like 1.5% at a time of your overall portfolio into a business. If you're going to end up with, let's say, approximately 15 stocks or 12 stocks in your portfolio. So you don't need to have more than 20 stocks. I mean, like your 21st idea is not going to be better than your first 5 ideas. So start really, really small. The other thing is someone said to me, "Oh, Michael, I like reading your stuff, but I don't really agree with everything that you say." And I said, "So, man, I don't agree with myself all the time. I'm like, on Monday I'll say one thing to my wife, and by Tuesday I'm saying something else. And she's like, why did you say that yesterday? I mean, things change. People are human beings. Like, you don't always need to agree with me. I'm just providing a framework for you to think about through. You can leverage my experience, and you can say, okay, this is like how Michael thinks about certain things, and like that makes sense to me. That doesn't make sense to me. I want to read a bit more about that, or kind of just you don't always need to agree with me. That's absolutely fine. I don't expect you to always agree with me, but just I hope that you're able to kind of open your mind and have a little think through and take a different point of view. That's all I'm going to say. Okay. So it's quite interesting that right now the S&P is pretty much at all-time highs, pretty much, while so many small cap stocks are actually close to a 52-week low. I've heard the statistic the other day that there are more 52-week low stocks right now than during COVID. So there are more stock like the COVID, meaning March 2020. There are more stocks hitting 52-week lows right now than there were during the COVID period, and it makes you think, right? So there's this huge discrepancy, and I believe, I don't know, but I believe it's because ETFs are just having to buy the biggest market caps anyway, and you on the other side of the equation, the smaller cap businesses, okay, they look fragile, it looks uncertain, their future. The future they can be meaningful or they may not be meaningful, and within tech there are a few names that are still really, really expensive. And I don't want to kind of say any names, because if you own a stock, you're going to say, "Oh, I own a stock and I'm right." And I don't want to give you concrete names that I've seen, but you know that there are certain names out there in tech that that are really expensive. And for example, yeah, I don't want to give you any names, but anyway, there are a few pockets, but those pockets are few and far between. But a lot of tech names are really meaningfully sold off right now, and it's kind of interesting because there's such a large discrepancy. And I get it because big money, like going into December, they don't want to start opening up a pick now. They want to get their bonus at the end of December. They don't want to kind of spoil their portfolio because the market is so volatile right now that in a matter of days you start you if you're an institution or hedge fund, you kind of make a new selection and the stock sells off 30%, there goes your bonus. You're not going to touch that. Um, Retail investors are often kind of so kind of phobic. They only want to kind of get in when the water's calm. But it's kind of an interesting period right now where there's such a large discrepancy between like the large caps, meaning something around 500 billion and upwards, and like the smaller caps, kind of around 80 billion and lower. There's just such a wide gap. I believe that if you're willing to kind of move away from those large cap names and kind of consider some slightly, you know, less followed names, I think that is quite an interesting period to invest right now. Um, so now we're going to talk about the book recommendations. So one of the favorite books of mine is Thinking Fast and Thinking Slow. I think that this is a book that's really worthwhile reading. I've read this book twice, and it's not the easiest book in the world to read, but it will pay you huge dividends in life and in investing if you just spend a bit of time getting acquainted or reacquainted with this business, this book. A lot of to do with investing is really about behavioral finance, and it's not that you have to be the smartest person in investing or best business analyst. A lot of it is just how you develop your temperament towards investing, and I think that this book is really helpful in that front. The next book that I want to highlight is Terry Smith's Investing for Growth. So I kind of picked out this one little bit, which Smith reminds readers that for a forecast to be useful, it has to be accurate. And that includes in terms of timing, but also one needs to know what the market expects. And it's common sense, right? And it's something that we've all heard before many times, but it's just so nice to be reminded about that. And for some people, Terry Smith is kind of like, he's just a bull market baby. Other people kind of give him a lot of credit. I don't pass any judgment on Terry Smith. I think he's done more good than bad. But what I find quite interesting about his book is just how much he kind of talks about that it just reminds people about ultimately the driver of the business is that business's ability to have high returns on invested capital and redeploy that capital back into the business to continue growing it for its next expansion period. I think that's quite helpful just to be reminded. It's like pounding it in, like going to church every Sunday. Everyone knows these things, but it's just kind of nice to be reminded. Along the same lines, when I was reading that, I was kind of thinking myself that what Howard Marks talks about, that it's not good enough to be right, because if you're right but too far ahead of your time, it's indistinguishable from being wrong. And you saw that a lot with, let's say, pets.com back in 2000. It's a reasonable idea, but they were just too far ahead of the time. They were trying to kind of ship food, and it's kind of a joke on me because I'm actually invested in Bark.com, Bark Eats or Bark. I don't know. They changed the original Bark or Bark, like they changed the company name, but it's kind of a joke on me because I kind of invested in Barks, and I bought into the stock at $14 and now it's like at $3. So it's like, yeah, kind of like clearly I should have read and thought about that line a bit more. But it's kind of interesting, the business, underlying business itself, the idea that with pets.com, they kind of, it was a good idea. It's just that they hadn't ironed out that the customer wasn't quite ready to embark on that journey with them. So yeah, I think that's quite a helpful quote to think about. The final book that I want to talk about is Seth Klarman's Margin of Safety. So a few things to point out about Seth Klarman's Margin of Safety. He wrote that book when he was 25 years old, and it's a phenomenal book. It's a book that you cannot buy on Amazon, but if you look at Seth Klarman's videos on YouTube, he acknowledges that there are kind of free copies available, and he says that if you want to get hold of a free copy, he wouldn't be too put out since I'm a billionaire already. It doesn't make a big difference to me. So there are a lot of anecdotes there to kind of keep you engaged enough, but it still doesn't take away from the difficult questions about investing. I think that this is a good quote that's part of the book, is that once you adopt a value investment strategy, any other investment behavior starts to seem like gambling. And I think that's really helpful. A lot of people kind of have this attitude that I'm going to buy into a business, and if it goes up, I'm going to sell it, or if it goes down, I'm going to sell it. I'm like that's just that's irrespective of what the actual underlying business is doing. So I don't think that that is a particularly helpful strategy. The other one is the famous sardine story. That is that the story is sardine trading. So commodity bidders were bidding up the price of sardines, and the price of sardines soared. And then one buyer decided to treat himself to an expensive meal, opened up the can of sardines, didn't like it, and they told the seller of sardines, "Hey, this sardine is no good." And the seller says, "Hey, you don't understand. These sardines are not for eating; they're trading sardines." And that life is a story about share prices. That the share price is much more than just a price going up and down. It's actually pegged to the value of the underlying business. So I think that's kind of helpful, and I strongly recommend that people read that. And the final one that I wanted to kind of point out is that what does it mean to be a contrarian investing? So to be contrarian, you also need to be correct, right? So it's not good enough to kind of be contrarian for contrarian sake, because it's quite a difficult endeavor. So, and if you're correct when everyone else is correct, then it doesn't really add much either. And it kind of may work in a short period of time, but over a 6 month or year period, if you're right when everyone else is right on the same stock, like you're not going to get much value out of that. So, the final takeaway that I wanted to put out there is that when it comes to investing, you have to have enough stamina to be able to come out the other side, because it's absolutely fine to because it's absolutely foolish to assume that just because you buy into something that's cheap, that tomorrow morning the market will say, oh, like the share price is cheap because John bought it, and now it's going to revert back up. You have to have stamina. You have to have the ability not to get overwhelmed. That's why I said at the beginning, start small when you invest. Kind of put in a small amount, space out by time rather than by share price. So you say you buy it, let's say at $10, and the share price goes to $8. That doesn't mean you have to invest. You don't have to do anything. Let time do its thing. If, let's say, 6 or 8 weeks have passed, then you may reconsider buying some. Not you buy at time increments rather than at when the share price moves in a certain direction. So it's about letting time do its thing rather than trying to time the market. I hope that all this has been quite useful for you. If it has been useful, please drop me a like. That's kind of very motivating for me to kind of see that it's resonating with people. People find it helpful. I try and release this once a week on a Friday. Don't forget to drop me some questions if there's something that I kind of interests you that you'd like to talk about and that I haven't addressed myself. Yeah, I mean, that's pretty much all of it. Thank you so much for listening, and yeah, I'll see you next time. Bye bye.